macro currency signals.
What you are witnessing right now in the silver market is not noise. It is not volatility. It is not a speculative bubble forming on the edges of financial Twitter. It is something much deeper, much more structural, and much more dangerous to the status quo than most people understand. Silver has just given a signal, and not a small one, not a maybe, not a coincidence. A final signal, the kind of signal that only appears when pressure has been building silently for years, and the system holding it back is running out of room. For decades, silver has lived in a financial cage, priced through derivatives, leased through opaque channels, represented through contracts that outnumber the actual metal by absurd multiples, a market where promises traded faster than ounces ever moved, and as long as that structure held, the illusion held. The illusion that silver was abundant, the illusion that supply was elastic, the illusion that price discovery was natural. But illusions don't survive stress forever. Before we move forward, if this is resonating with you, hit that subscribe button and switch on notifications. In moments like this, being ahead of the curve isn't optional. It's everything. Drop a comment below and tell me where you're tuning in from and what time it is on your side of the world. This isn't just a local discussion. It's global, and it's powerful to see how far this reaches. Now, let's dive back into what just unfolded. What happens when the physical world begins disagreeing with the paper world? What happens when the place where real metal moves starts pricing silver at one level, while the place where leverage dominates keeps it somewhere else? That spread is not random. That divergence is not trivial. It is the market whispering first, then warning, and eventually screaming. Because here's the truth no one likes to say out loud. Silver is not just a commodity. It is infrastructure, it is circuitry, it is conductivity, it is weaponry, it is solar grids, it is AI hardware, it is aerospace, it is satellites, it is the nervous system of modern civilization. And demand for that nervous system is not slowing down. We are living through an era of electrification at a scale humanity has never attempted. Electric vehicles replacing combustion fleets, solar capacity expanding exponentially, data centers multiplying to feed artificial intelligence models that require immense processing power, defense spending accelerating across multiple regions simultaneously. Every one of those sectors consumes silver, not as a luxury, not as a substitute, as a necessity. Silver is inelastic in the most dangerous way possible. You don't need a ton of it per device, but you absolutely need it. There is no efficient replacement for its conductivity in high-performance applications. When you are building advanced electronics or precision military components, you don't downgrade materials to save a few dollars per unit. You secure the best. Now combine that inelastic industrial demand with constrained supply. Silver is primarily a byproduct metal. It is mined mostly as a secondary output from copper, lead, and zinc operations. That means silver supply does not simply increase because the silver price rises. It increases if base metal mining increases. And base metal mining is cyclical, capital-intensive, politically complicated, and slow to respond. So when industrial demand rises structurally and supply is relatively rigid, deficits form. Quietly at first, then persistently, then critically. We have been running structural silver deficits for multiple consecutive years. Above-ground inventories have been declining. Visible exchange inventories fluctuate, but the broader global stockpile has been shrinking relative to consumption. And when inventories fall below a certain psychological threshold, behavior changes. Fabricators begin securing supply earlier. Governments begin classifying materials as strategic. Export controls appear. Lease rates spike. Delivery requests surge. These are not speculative signals, these are stress signals, and here is where things become explosive. The silver price that most people look at is largely formed in derivative markets. Contracts representing massive quantities of silver trade daily, often settled in cash, rarely resulting in delivery. This structure allows price to be influenced by leverage far beyond physical availability. It works as long as confidence holds, as long as most participants roll contracts forward instead of demanding bars. But what happens when more participants stand for delivery? What happens when entities begin pulling metal off exchange instead of trading paper exposure? What happens when the appetite for possession overtakes the appetite for speculation? The leverage ratio becomes a liability. If too many contract holders demand physical settlement simultaneously, the system must source real metal. And in a tight supply environment, that sourcing becomes expensive, fast. Now add geopolitics. When nations begin viewing critical minerals through the lens of national security, markets change character. Export controls are not implemented for cosmetic reasons. They are implemented to prioritize domestic stability and strategic advantage. Licensing requirements slow flows. Approved exporter lists concentrate power. Bureaucratic friction becomes a lever. Even small slowdowns in a just-in-time global supply chain can ripple outward dramatically. Industries that operate on tight margins of inventory cannot tolerate prolonged delays. They hedge against that risk by stockpiling. Stockpiling tightens markets further. And here's the part that most analysts underestimate. Psychology shifts before price does. When industrial users fear shortage more than they fear paying a premium, they front-load demand. When governments fear dependency more than they fear optics, they restrict exports. When investors observe widening spreads between physical and paper pricing, they question the integrity of price discovery. That questioning is dangerous for leveraged systems, because once trust in paper pricing erodes, velocity changes. People move from synthetic exposure to tangible ownership. And that transition is rarely orderly. Silver is a small market compared to global capital pools. It does not take sovereign wealth, pension funds, or institutional reallocations of significant size to overwhelm available float. The annual mine supply of silver is tiny relative to global financial assets. A fractional shift in asset allocation could overwhelm supply. Now imagine that shift occurring at the same time industrial users are hoarding and export controls are tightening. This is how nonlinear repricing events occur. Markets under suppression do not drift upward when the dam breaks. They gap, they overshoot, they shock participants who assume stability. Look at history. Commodities subjected to artificial constraints or long periods of price control do not correct gently. When oil broke in the 1970s, it did not inch upward politely. When rare earth exports were restricted in the early 2010s, prices did not adjust gradually. When palladium entered structural deficit, it did not ask permission before tripling. Silver's historical volatility is not a flaw. It is a feature of small, strategic markets under stress. Now ask yourself a question. If silver were to break decisively above previous highs, how many short positions would be forced to cover? How many derivative structures would unwind? How many hedges would be recalibrated? Short covering in thin markets is gasoline. And this brings us to the unthinkable number, $1,000. At first glance, it sounds absurd, hyperbolic, clickbait, impossible. But price targets are meaningless without context. What is $1,000 silver in an environment where currencies are being diluted at historic rates? What is $1,000 silver if trust in sovereign debt erodes? What is $1,000 silver if defense spending continues accelerating, if electrification continues scaling, if supply remains structurally constrained? Markets do not move based on what seems reasonable. They move based on imbalances. And the imbalance forming in silver is not speculative mania. It is structural tension. Could silver reach $1,000 in March 2026? That depends on whether the physical paper divergence accelerates. It depends on whether delivery demands intensify. It depends on whether export restrictions expand. It depends on whether industrial users panic buy. It depends on whether confidence in leveraged price discovery fractures. But here's what matters more than the exact month. The signal has been given. Widening spreads between physical and derivative markets, rising lease rates, persistent structural deficits, strategic classification of silver, export licensing bottlenecks, industrial stockpiling behavior, record delivery months. These are not retail hype indicators. They are systemic stress indicators. And systemic stress, once visible, tends to accelerate. The silver market has been conditioned for decades to believe in suppression, to believe in ceiling prices, to believe that rallies will be sold, that spikes will fade, that momentum will die. Conditioning creates complacency. Complacency creates vulnerability. If enough participants assume silver cannot escape a range, positioning builds accordingly. When price invalidates that assumption, positioning unwinds violently. Think about the mechanics. If silver were to break past psychological thresholds, $100, $200, $300, media attention would amplify. Retail demand would surge. Exchange inventories would drain faster. Short positions would scramble. Industrial users would front-run each other. Governments might respond with additional controls. Feedback loops compound. And remember, silver is not just monetary, it is industrial. That dual demand base makes squeezes uniquely powerful. Gold can spike primarily on monetary fear. Silver can spike on monetary fear and industrial panic simultaneously. Now layer macro conditions on top. Global debt levels are at historic extremes. Monetary policy credibility has been strained repeatedly. Inflation cycles have proven more persistent than expected. Currency debasement is subtle but cumulative. Real yields fluctuate, but structural fiscal imbalances remain. In such an environment, hard assets regain attention. But silver has lagged gold historically in recognition. When silver finally catches the narrative, its smaller market cap makes percentage moves larger. So the question is not whether $1,000 sounds dramatic. The question is whether the ingredients for exponential repricing are assembling. Structural deficit, geopolitical friction, export control, industrial hoarding, leverage imbalance, delivery stress, currency dilution, psychological shift. If those variables converge inside a compressed time frame, price does not move linearly. It explodes. And here's the part most people miss. You don't need everyone to believe in a $1,000 silver. You need enough participants to believe that the current price is wrong. Because when enough capital concludes that silver is materially undervalued relative to its strategic importance, flows begin. And in a thin market, flows dictate price. March 2026 is not a prophecy, it is a scenario. But the signal we just received suggests the timeline for repricing may be accelerating. When physical markets trade persistently above derivative benchmarks, when delivery volumes stretch historical norms, when lease rates spike far beyond complacent levels, when governments insert themselves directly into export pathways, the message is clear. The old pricing regime is under stress, and when pricing regimes fail, the transition is rarely polite. It is violent, it is disorderly, it is shocking to those who trusted the old structure. Silver just gave the final signal. The pressure is building, and if the dam breaks, it will not ask permission. Now let's take this one level deeper. Because if silver were simply undervalued, that would be interesting. If it were simply in deficit, that would be notable. If it were simply experiencing geopolitical tension, that would be manageable. But what makes this moment different is compression. Compression of time, compression of supply, compression of trust, compression of leverage. And when multiple forms of compression stack on top of one another inside a small strategic market, the release is not gradual. It is violent. Imagine a spring being pushed down for decades. Every rally capped, every breakout faded, every momentum surge met with overwhelming paper supply. Traders conditioned to short strength, investors conditioned to expect disappointment. That repeated suppression doesn't eliminate energy, it stores it. Now overlay a structural shift, where physical demand is no longer passive. Industrial users are not price speculators. They are survival buyers. When they sense tightening supply, they don't wait for confirmation from a chart. They secure inventory, they extend contracts, they pay premiums. And the moment that behavior becomes widespread, available float shrinks fast. At the same time, investors who have ignored silver for years begin noticing anomalies. Lease rates that were once near zero spike to levels that imply desperation. Delivery volumes that were once routine become persistent. Premiums between regions widen and refuse to normalize. These are not retail-driven distortions. These are institutional stress signals. Now think about leverage. The derivative structure around silver was built on the assumption that most contracts would never demand metal. It works as long as confidence in settlement holds. But if even a modest percentage of participants shift from rolling contracts forward to standing for delivery, sourcing physical becomes exponentially harder. And when sourcing becomes harder, price becomes the pressure valve. A short position in a rising commodity is uncomfortable. A short position in a commodity experiencing delivery strain is dangerous. A short position in a commodity where physical supply is tightening while global capital begins reallocating is catastrophic. This is where acceleration begins. Picture this scenario. Silver breaks above a major psychological threshold. It doesn't stall, it doesn't retrace meaningfully. Instead, it consolidates briefly and pushes higher again. Technical traders flip from short to long. Momentum funds allocate, media attention grows, retail interest returns. But here's the twist. This time, the physical market is already tight. So instead of speculative flows being absorbed by comfortable inventory levels, they collide with scarcity. The higher price goes, the more industrial buyers panic. The more they panic, the more they front-load supply. The more they front-load, the less remains available for financial settlement. It becomes reflexive. Higher prices create more urgency. More urgency reduces available supply. Reduced supply drives higher prices. Now introduce sovereign behavior. When governments classify a material as strategic, it means they view access as essential to national stability. If silver is essential to energy transition, defense systems, and technological leadership, then maintaining domestic supply becomes priority number one. Export restrictions can expand, strategic stockpiling can intensify, domestic producers can be incentivized to keep metal internal. Every additional layer of restriction amplifies tightness globally. Now imagine this happening in early 2026. Global markets already volatile. Debt markets strained. Equity valuations fragile. Investors searching for hard asset hedges. Gold moving steadily. Silver lagging slightly behind, then suddenly catching up, fast. What happens if silver doubles in a matter of weeks? Margin calls ripple outward. Derivative counterparties demand collateral. Volatility products spike. Risk models recalibrate. Portfolio managers scramble to rebalance exposure. And in a market as small as silver, liquidity disappears quickly during vertical moves. We've seen glimpses of this dynamic before in other commodities. When supply shocks collide with leverage, exchanges sometimes intervene. Trading halts. Margin requirement increases. Position limits adjusted. But those tools do not create metal. They only slow the tape. And if physical demand continues while paper trading pauses, the underlying imbalance worsens. This is how you get gap moves. Now let's confront the $1,000 question directly. For silver to reach $1,000 by March 2026 would require a move that most market participants would consider impossible under normal conditions. But these are not normal conditions. That level would likely imply a breakdown in confidence somewhere larger than silver itself. It could signal currency stress. It could signal derivative failure. It could signal sovereign accumulation at scale. It could signal industrial panic colliding with financial short covering. In such an environment, silver would not be rising in isolation. It would be repricing relative to systemic risk. Remember, silver's market size is tiny compared to global bond markets, equity markets, or even gold. A reallocation of a fraction of global capital toward physical silver could overwhelm annual mine supply multiple times over. You don't need trillions. You need a few $100 billion aggressively chasing limited inventory. Now think about investor psychology during crisis. When trust in financial institutions weakens, tangible assets gain appeal. But not all tangible assets are equally accessible. Real estate is illiquid. Infrastructure requires scale. Art is niche. Silver, by contrast, is divisible, transportable, industrially critical, and historically monetary. If confidence cracks broadly and silver is already tight, the repricing could overshoot dramatically. And overshooting is what markets do when they've been suppressed too long. Consider the path. Silver breaks $150. Analysts call it overextended. It breaks $250. Commentators say it's a bubble. It breaks $400. Exchanges raise margins. It breaks $600. Headlines scream. Industrial buyers scramble. Governments review export policies again. Short positions evaporate. At that point, price is no longer about valuation. It's about availability. And that is the key difference between steady bull markets and vertical repricing events. In steady markets, price reflects gradual reassessment of value. In vertical markets, price reflects fear of exclusion. If you are an industrial consumer and you believe silver may become unavailable, price becomes secondary. You secure what you can while you can. If you are a financial institution short silver and price is accelerating, survival overrides thesis. You close positions regardless of conviction. If you are an investor watching parabolic movement fueled by structural deficit, you chase momentum. These forces compound. Now layer in modern information velocity, social media amplification, real-time global data flows, instant retail participation. Capital moves faster than ever before. Narrative spreads faster than ever before. Panic spreads faster than ever before. A vertical silver move in 2026 would not unfold like it did in previous decades. It would unfold in hours and days, not months. So could $1,000 print? Under stable monetary conditions, unlikely in that time frame. Under unstable conditions where multiple stress vectors align, entirely within the realm of possibility. But understand this clearly, a $1,000 silver price would not mean prosperity. It would likely signal dislocation. Something larger would be under strain. Because when a strategic metal increases tenfold in a compressed period, it is rarely because everything is fine. And here is the most uncomfortable truth of all. The signal silver just gave is not about greed, it is about warning. Widening spreads between physical and paper markets are warning signs. Persistent delivery strain is a warning sign. Export restrictions are warning signs. Rising lease rates are warning signs. Industrial hoarding is a warning sign. These are stress fractures forming beneath the surface. Most people will ignore them until price forces attention. That's human nature. Markets rarely prepare calmly for discontinuity. They react to it. So when you ask whether silver could hit $1,000 in March 2026, the better question is this: what kind of world would produce that outcome? A world where leverage met scarcity. A world where paper promises collided with physical limits. A world where geopolitical strategy intersected with industrial necessity. A world where confidence cracked at the exact moment inventories ran thin. Silver is small enough to move violently, strategic enough to matter deeply, leveraged enough to be unstable, ignored enough to shock the majority. And now, after decades of compression, it has begun signaling that the old equilibrium may not hold much longer. If the divergence between physical reality and financial representation continues widening, if delivery pressure persists, if export constraints expand, if industrial demand accelerates, if capital reallocates even modestly, then the move will not be polite, it will be explosive. And here's the ending. Silver does not need hype. It does not need viral posts. It does not need promises of overnight wealth. It is giving signals rooted in structure, not speculation. If those signals intensify, the repricing event ahead will not resemble anything most investors have experienced in their lifetime. $1,000 by March 2026 is not a fantasy number thrown into the air. It is a stress test scenario for a system stretched thin. Whether it happens or not will depend on how much longer the paper world can ignore the physical one. But one thing is clear. The final signal has been given, and when strategic metals begin breaking free from financial constraints, the explosion that follows rarely asks for permission. And here's what it all comes down to. Silver doesn't move like this without a reason. It doesn't send structural signals, flash physical premiums, strain delivery systems, tighten exports, and spike lease rates just for entertainment. These are not random market quirks. They are pressure readings. Pressure inside a system that has depended for decades on leverage, confidence, and the assumption that most people will never ask for the metal. If that assumption fails, even slightly, the math changes. If industrial users continue locking in supply, if governments continue prioritizing domestic control, if more contracts demand delivery instead of settlement, if capital starts rotating out of fragile financial assets and into tangible ones, then the repricing will not be gradual. It will not be orderly. It will not wait for consensus. It will happen fast. Could silver hit $1,000 by March 2026? That number is less important than the mechanism behind it. Because if we ever see that price print, it won't just mean silver went up. It will mean something in the global system broke loose. Silver is small, strategic, inelastic, leveraged, and historically suppressed. That combination is rare, and when rare combinations unwind, they don't whisper. They detonate. The signal has been given. The divergence is widening. The stress is building. Now we wait to see whether the dam holds or whether the explosion rewrites the rules entirely.